Amazon shares are popping, of course, after a top and bottom line beat. Cloud revenue growth up 19%, better than a year ago, but still lagging the growth of more than 30% from Microsoft and Google's cloud business. Cowen senior internet analyst John Blackledge joins us with a buy rating and a $240 price target. You raise that based on what you see as the numbers from the quarter and the guidance from the quarter. What do you think generates additional upside from here, especially given today's moves?
Yeah, I mean, well, if we could just click back to the quarter and the guide. I mean, Amazon definitely delivered some treats for investors last night with the strong 3Q results that included the blowout margins. Amazon was 1%, 19%, and 25% above street consensus revenue, operating income, and earnings. Key drivers of the margin beat were AWS advertising and other cost efficiencies. And then what helps drive the stock is, they gave this 4Q outlook that was really strong, right? Revenue guide range bracketed us in street consensus. And then the op income guide range was huge, well ahead of investor expectations. CapEx growth is also accelerating with this AI infrastructure build out. But all in, we ended up raising our long-term revenue and earnings forecast, also raised CapEx. And like you said, we went to 240 on our price target from 230 and maintained.
Do you think that there's room for them to expand that operating income and margins from here, especially given all the projections for CapEx? I mean, you're saying that you're forecasting $75 billion of CapEx in 2024, up 57% year over year.
Yeah, we expect further margin expansion like into 25 and going forward. And the drivers of it will be, obviously AWS, which actually had blowout margins in 3Q, sustained mid-30s AWS margins. The advertising business, which is growing like almost 20%, that's going to continue to grow very quick and has been a huge benefit for the company's margin trajectory over the last couple of years. And then the thing that's going to help next year, it's going to help a little bit in the fourth quarter, is around fulfillment efficiencies. So they went to a regional fulfillment model last year, and then they're working on, they were talking about it last night, the inbound fulfillment network. They opened up 15 inbound fulfillment centers. They're open now. It's going to help margins in 4Q, and then it will really help as they build that out next year. So those are some of the things. The other thing that dynamic that we've seen is unit growth has exceeded shipping cost growth the last 4 quarters. And the unit growth accelerated this past quarter. It's being driven by fastest delivery speeds in Amazon's history. And also Amazon is leaning into low priced items where they think they're underpenetrated. But since they have lower cost to serve over the last couple of years, we see this dynamic of faster unit growth and shipping cost growth, which is also kind of good for margins over the long term.
Pretty remarkable move today, John, up more than 7%. We really appreciate your time and for breaking these results down for us.
Thank you.